Hello and welcome to MoneyControl. I'm your host Nickey Mirchandani and you have tuned into IPO Watch. Today we are going to be talking about SAMHI Hotels, the company which is going to be coming up with an IPO of around 1,370 odd crore on September 14 with a price band of roughly 119 to 126 crore. The IPO comprises of two components, OFS, which is to an extent of 170 crore, and fresh issue to an extent of 1,200 crore. In pre-IPO placement, you have Madhu Kela's wife, Madhuri Kela, along with a few of the investors who picked up around 1% equity just for Madhu Kela's investment there. But to take the discussion forward, we've been joined by the company's managing director, Ashish Jakhanwala, who's going to be talking through the financials about the company profile and the strategy. Hello and welcome to IPO Watch.
Thank you.
I'm going to start off by asking you your assessment. What explains the losses for the last 3 consecutive years? When do you think you'll break even at the net level?
So, Nickey, if you see 2021, 2022 fiscal years, losses were largely on account of COVID because the sector was the worst hit. In FY23, what's important for investors to see is if you look at the fine print, there were almost 290 crores of non-recurring one-time finance cost, right? So even though we had an EBITDA of about 311 crore, our net losses were about 365 crores. And the losses between EBITDA and the net loss was really depreciation about 129 crores.
Right.
And then we had a very high finance cost,
Right.
Which is, as I said, one-time non-recurring, but also the recurring cost is high, which is what we're trying to address through the primary proceeds.
Sure. I'm going to touch base on your, finance cost in just a bit. But before that, I'd want to understand about your model a little more in details. An asset-heavy model, how efficient is it as compared to the peers, especially at the time when the industry is now moving towards the asset-light model? How different are you placed in terms of peers? What's the strategy going ahead?
So, Nickey, as of today, we derive 100% of our revenues from the assets that we either own or we have leased.
Right.
Okay. And if you look at the immediate peers in hotel industry in India, most of those companies would derive their income from owned assets to the extent of 88 to 90%, right? So as of today, I think there's not much differentiation between where the source of income is for most hotel companies in India, right? On a going forward basis, I think each company needs to find a more capital efficient way to grow. For us, there have been really 2 pivots. One is the fact that we do acquisition and turnaround led growth. So we really don't pay the price to build a hotel. You can do that at a significant discount to replacement cost.
Right.
2, about 13% of our revenues come from variable leases. And that's a sort of an asset-light model where you don't pay for land and building. You take on a building for a lease for 30 to 60 years and you pay a percentage of the revenue as lease rent, right? So I think we are also adopting to making our business more capital efficient in future. But as of date, the difference between us and our peers is we derive 100% of income from owned and leased assets, and some of the other companies have that at 88 to 90%.
So I'd want to understand more about this, about the strategy that you've taken in terms of the USP that we're looking at. Also, you spoke about the company essentially focuses more on the inorganic growth. So A, what's your revenue potential rate X your inorganic growth plans that you might have? That's number 1. And number 2, have you identified any pockets?
So, Nickey, 2 things. First, today we have our revenues coming from about 4,800 rooms. We will expand that 4,800 rooms to about 5,400 rooms. That's about 13% growth in inventory. And that will happen through the assets we today hold on our books. So we don't need to really make a acquisition, right? 2, we are also undertaking about 900 of our existing rooms through a renovation and rebranding. And historically, we've seen that creates a very significant upside to the business.
Right.
So for the next several quarters, the company has secured its growth. And that's a part of the balance sheet that we have today, right? In the long term, I think once the company starts producing free cash from its operations, which should be not too far in future.
When you say not too far, that would be?
We can't give specific guidance, but if you look at a EBITDA run rate in FY23, and if you look at the debt being reduced from 2,800 crores to almost 1,700 crores from the IPO proceeds, right? The maths is fairly simple that you'll start getting reasonable free cash, right? So in the long term, that free cash will be used both for constant deleveraging and on the other hand, continue to look at some interesting acquisition opportunities. Do we have a list ready? Absolutely. For the last 10 years, we made a tracker of interesting opportunities where there is a significant opportunity of price versus value. The price we pay and the value that we get, right? And that's cyclical, that's structural, that's not cyclical nature. So once we get to that point and we have added these 600 rooms to our existing portfolio, I think we have some interesting opportunities coming our way.
Okay, so going forward, how would you fund these inorganic expansions? Internal accruals, like you
yeah,
just said.
Absolutely.
Any pockets specifically that you think you can let us know, the segments where you'd be focusing, geographies, a little more details perhaps, which can help us provide some color?
No, actually, it's very easy, even geography, right? We have been an owner of business hotels in gateway cities in India. And I
Okay.
define gateway cities as cities which have a large pool of office space and aviation market. Our focus will continue to be business hotels, starting from a mid-scale hotel, going up to an upscale hotel, and in gateway cities across India. So, to extent of discipline, people can fairly be comfortable about the fact that we're densifying high-density office markets in India, and that will continue to be a focus for foreseeable times to come, really.
Right. That's also one way of looking at it, because I wanted to understand essentially your debt, your leveraging, because that seems to be a cause of concern
Yeah.
for the industry. How leveraged are you as compared to your peers? What's your current debt position looking like? When do you intend to be debt free? That's the $1,000,000 question that I think most of us would want to know, given the turnaround
Yeah.
that you've been talking about in terms of your leveraging story.
Yeah, so Nickey, if you see, both things are moving rapidly. The growth of income and with the IPO, the start of the deleveraging story, right? If you look at SAMHI, our EBITDA has grown from 172 crores in FY20 to 311 crores in FY23.
That's right.
So we've seen really, really humbling growth in our portfolio in a pre-pandemic to post-pandemic, right? Our leverage today is at about 2,850 crores net debt. And as I said, we are taking a very large primary issuance of 1,200 crores. Almost all of it goes towards deleveraging the balance sheet. So we post IPO, we start from 1,700, 1,750 crore of net debt. We think that that level starts producing free cash, which then helps us add that new inventory, maintain a very healthy EBITDA growth. And on the other hand, part of that also gets used to constant deleveraging. So that's part one.
Right.
Part two, about when do you see us debt free? I think our view is with the strong momentum we are seeing in the sector in terms of revenue growth and margin expansions, right? We think we'll be at a very, very comfortable debt to EBITDA levels in the next, I would say, year and a half to 2 years. Will it be debt free? I think that's a call the board will have to take nearer to that moment.
But is that a strategy that you're also looking at, or do you? It's not necessary that debt on book is a bad thing to look at, right? For some people, the growth strategy is perhaps more important as compared to just going debt free in the first place.
Nickey, that call needs to be taken depending on what's the opportunity cost of capital, right? If a year and a half, 2 years from now, we think that there is tremendous opportunity for us to reinvest that capital for capacity creation, for some inorganic acquisitions, and they can produce a really good equity return, I think it's a fiduciary to direct that capital towards growth. But if we think the opportunity of redeploying that capital is not very accretive, then it's actually a great thing to go and start deleveraging the balance sheet, right? So any professional board will look at what is the return profile from reinvestment capital, right? But having said that, what is important is I think that debt levels should be, in our opinion, and we don't want to give a future promise or guidance, but we think the debt level should be at a point where you have a multi-year comfort.
What level are you comfortable with? Let's start with that. What is the optimum level that you're looking at? If you don't want to provide a color of when do you intend to be debt free, at least give us a level at which you're comfortable at.
So I think in our business, because most of the debt tends to be long term, 12 to 14 years, right? It's not short term debt.
And you have all your debt also as a long term debt, right?
So because you have the backing of the assets, you can secure long term debt. In a situation where you have 12 to 14-year long term debt and circa pricing of, let's say, 9.5%, 10%, if you are levered 3.5 times debt to EBITDA, you're in a very comfortable position. Because your interest cover will be substantial, your debt cover will be pretty high. But as I said, whether 3.5 is adequate will be decided on the day, depending on what the opportunity cost of that capital really is.
Fair enough. Also, any guidance on your cash flow, since we are on the topic of financials? Cash at the end of the year, correct me here if I'm wrong, it was around 118 crore as of FY23. So how do you intend to grow that? Because you said that your inorganic expansions will take place through your internal accruals, which means that the cash projections have to have been higher, to kind of fund that kind of inorganic expansion. So what's the growth strategy
there? So Nickey,
there?
first of all, our cash position improved after the ACIC acquisition because that company also had certain cash in the balance sheet. So on a pro forma basis, we actually have a much stronger cash position than what is on our balance sheet as of 31st March 2023, right? So that's the starting point.
Okay. What is that position?
Crores, 180 crores, right? That's the starting point. The second, as I said, is that we are deleveraging to a level where the business starts producing free cash, right? So therefore, we expect that the near-term growth opportunities that I was talking about, addition of 600 rooms, renovation of 900 odd rooms, all of that actually requires only about 420 crores of total capital expenditure, because majority of that has already been spent in the prior years.
Right.
That 420 crores is going to be funded from the cash on books plus the internal accruals we'll get over the next, because all these capital expenditure will take 3 years, right? So all of that will be comfortably funded from internal accruals only. No leverage is required, no capital raise is required. Having said that, as we complete that renovation, rebranding, and expansion, that also create a significant opportunity for EBITDA expansion, right? So that's why I think we're very comfortable, and we took the bold call of upsizing the IPO from 1,000 to 1,200 crores, so that start of the growth and the deleveraging story is sorted in one go rather than in incremental steps. And we gave investors full visibility of where we are going.
All right, that still doesn't answer my question as to cash on books. What's the growth percent that you're looking at?
No,
if
so
one
Nickey,
can just
for
give a very...
for giving cash growth, I have to go into revenue growth and EBITDA growth.
So that's exactly my next question then. What is the peak potential rate for your revenue? What kind of revenues are you targeting?
So Nickey, we have seen last year, the average rates grow in double digits, right? We have seen our peers have grown their revenues in double digits, right? The operating leverage in this business is always very strong. So if your revenues grow at 10%, your EBITDA should grow at 13, 14%, right? And that's why you've seen some of our peers like Chalet, Lemon Tree, IHCL, the margins have expanded quite comfortably, right?
Correct.
I think without giving a specific guidance on our business, because we are not allowed to do that, what we can tell you, the cities we are located in, the price points we are located in, and the brands we carry are very similar to our peers. Right?
Okay.
So there is no reason to believe that our portfolio should not get similar level of growth, both on revenue and EBITDA going forward.
All right. So only place of concern where there is a little bit of difference, perhaps, as compared to that of your peers, is your debt level.
That's
which
right.
You intend to perhaps be a debt-free, or the debt to EBITDA comfort is at around 3 times, if I'm not wrong.
Right.
And that is targetable by what year?
I can't give that specific guidance today.
Okay. All right. Let's talk about your adjusted EBITDA in that case. 22 crore in FY22. That got increased to almost 260 crore. Have I got that right? And the first time, that's adjusted EBITDA A. What is that adjustment that we're looking at? Because it came out as an RHP, RHP parameter. What drives this growth, and what growth can be expected going forward given the kind of guidance that you've given in terms of expansion?
So Nickey, first of all, the EBITDA growth on a pro forma basis already happened from 261 to 311 crores because of the ACIC acquisition, right? As you know, from DRHP stage, we have been showing both numbers, SAMHI and on a pro forma basis.
Correct.
Because I think investors should get a full insight as to the business that we've already acquired. If this was acquired whole of last year, what the number would be. Otherwise, unnecessarily, the next year growth will look insanely high.
Right.
So our EBITDA as of 31st March 2023 was 311 crore. For the same period, FY20, it was 172 crores. FY21, FY22, I don't want to make as a reference point because the whole impact was pandemic, right? So growth numbers starting FY21, FY22 look really, really exciting, but that's not the right way of looking at it.
Sure.
But even 172 going to 261, same store,
Fair
and then
enough.
261 going to 311 crore has been
so then just in terms of the CAGR growth that one can look at perhaps on the top line for the next 3 years, is that a fair point?
So so I think the historical growth that we've seen in revenues and EBITDA, the market environment remains to be very conducive. The new supply is barely half of the demand growth, right? Most economic factors are tracking well for India. And I think we are not able to see sufficient reasons to believe that the growth will slow down.
So are you saying that you'll replicate the same amount of CAGR growth that we've seen from FY21 to 23? Is that the right parameter to look at it? Or are you looking at any other numbers for that matter?
No, I don't want to again make a promise about past.
No, it's just you're not putting in a projection, right? You're just letting us know whether you're going to be growing in at the same pace or perhaps a little more higher than what the pace has been, right?
Directionally, I think we would continue to grow at a very rapid pace, right?
Sure.
FY20.
How rapid is what I'm trying to gauge, perhaps that gives a more confidence within the investor community, given the time that we are looking at a deleveraging story. What is the peak potential?
We have seen occupancy remain stable in mid-70s through the last year. We've seen the rate growth happen almost 15% between the different quarters, right? So if we see a 15% rate growth, all of that comes down to your revenue growth and then to the EBITDA growth. I think one can assume those sort of growth rates are not necessarily challenged in the near future.
Okay, that's a fair point to look at. Also, in terms of the nature of your interest cost, which weighed down on the financial performance, specifically in terms of your bottom line. 500 crore in FY23. What was the nature of this one-off interest cost? That's one.
568 crores was the total finance cost.
Correct. Are there any convertible instruments of any nature which is pending with regards to the finance cost, and post IPO, how much will the interest cost come down by essentially?
So that's an easy one. So I'll tell you. So of the 568 crores of total finance cost, Nickey, about 297 crores was one-time non-recurring.
Okay.
Right? And that was because we had certain high-cost NCDs, some convertible instruments, and all the accruals were paid towards the end of the fiscal year. Then add conversion, you have to take some mark-to-market losses. So that 297 crores is a one-time done, dusted with. You're not seeing that repeat in the books in FY24.
Okay.
Right? That leaves us with about 270 crores of what I've called recurring finance cost. Right? That 272 crores of recurring finance cost was against a debt of 2,850 crores. Right? Immediately post IPO, that debt reduces from 2,850 to almost 1,750 crores.
Correct.
So you would actually see a significant reduction in that, even 272 crores of recurring finance cost.
So that 270 crore goes down to how much?
So if you see pro rata, it will go down to almost 170 crores.
So 100 crore reduction.
Absolutely.
Or let's just say that your interest cost will sit at from
11%.
540, it will come down to 100 crore for that matter.
It's simple as that. Our financing cost was.
So when do you intend to be a net positive on your bottom line in that case? Because these are numbers, already 400 crore gets knocked off.
Yeah, absolutely.
With the debt repayment.
So even if I take FY23 as a reference point, Nickey, because I can't give guidance for FY24 today. 311 crores of EBITDA, about 129 crores of depreciation expense, right? Which in our business tends to be non-cash, right? Because you're holding long-term assets, right? And then on top of that, if you look at the current cost of financing that we have, which is about 12.8, which is reducing to about 10.6 post-IPO, right? I think you're looking at the company being a profitable P&L in a very short order.
That's exactly what I wanted to know. When is the
But
turnaround story? Is it
a
FY24? Is it like a 2 years down the line journey? You've spoken about your debt to EBITDA level.
All I can say is invite me back in 6 months. I'll give you the answer.
We're going to invite you back on listing date, perhaps. That's the one.
No, do invite me back after 6 months.
That's the time you're probably going to share it a lot more.
Have the answer. But today, I think I will not like to make any. See, we are opening the issue tomorrow, Nickey, right?
Correct.
And all these conversations are 15 minutes. I do not want to mislead an investor on a very short conversation, right?
Correct.
But do invite me after 6 months. You'll have the answer loud and clear.
All right. So we're going to just leave it at that.
Yeah.
And thank you for taking out the time and speaking to us.
Thank you so much, Nickey. Thank you.